Let's start with the reality that nobody likes to say out loud. Global venture reached its peak in 2021 and then it crashed. By 2023, funding worldwide had fallen nearly 60%, rewinding the clock as if it was back to 2020. In 2024, money returned, around $314 billion was deployed, but more than a quarter of that went into AI alone. Meaning that if you're building anywhere else, well, that bar, it just got higher. Now, let's zoom into Africa. Venture deals across the continent fell by about 50% between 2022 and 2024, the sharpest drop of any region in the world. African startups raised roughly $3.2 billion last year, and that is less than 1% of the global VC. Most founders here are not just fighting for growth, they're literally fighting gravity. And all this is happening while Africa carries one of the world's youngest, fastest growing workforces, a demographic that's massively underemployed but hugely capable. 3 investors, people who see thousands of decks, term sheets, and dreamers every single year, sat down with me to talk about valuation, power, dilution, bad money habits, but most importantly, what it really takes to build a company in this African landscape right now. This is a VC roundtable. Nick Vilelle, one of the founding members of the Nairobi Business Angel Network. Nick has invested in 15 startups across Kenya and Ethiopia, and he's also had his own fair share of experience being a founder himself. Maina Murage, principal at Norrsken22, and previously an analyst at Dutch family office DOB Equity. He's backing what he calls the category leaders of tomorrow across the continent. Last but not least, Art Chupeau, managing partner at the Baobab Network. They back African founders at pre-seed level with $100,000 checks and an accelerator that's designed to de-risk those earlier bets. 3 different perspectives, one honest conversation about building in Africa. Hello, everyone, and welcome to another episode of the My Tech Story Africa podcast. Today is special because we are having our very first roundtable, and not just any roundtable, a VC roundtable with some of the best names in the game. If I was to hand each one of you $500,000 right now, are you building a company that you believe in, or are you building a company that you think investors want to see? Be honest. You can start, Art.
Sure. I think it's a very straightforward answer for me. I will always build the company I want to build. And I need to make sure I find advocates, be it stakeholder, customers, and obviously investor that are in line with my philosophy. It's not the other way around. I think, as a founder as well, here, obviously I have a hat of an investor, but as a founder, you always want to feel like this is your baby. And for anyone that has a baby, you are the one that drive their education. You're the one that drive their vision. And at some point, you're not involved anymore. It is that point for a startup, you've exceeded it or you basically not operating. But at the beginning, if you give me that check, I will make sure to build a business that follow my vision. And hopefully it attract other people.
Do you agree?
No, I think it's a very bad idea to try build a business for the investors. Because building a business is a really tough thing. And you're going to have a lot of problems. And if you're building it for someone else, I doubt you have the stamina to really continue through the problems that you're going to be having. Mm-hmm. And then also remember, investors were kind of investing from a portfolio perspective. So if things go wrong, we can leave companies behind. It's actually baked into the venture model where you do expect about half of your portfolio to not survive or have a very muted exit. So if you build with them in mind and not yourself, it might not be a great outcome for you in the end.
I think you've been very generous with your $500,000, and I think you don't need an investor if you get $500,000. I mean, we're seeing how easy it is to deploy with all the tools that are out there, so I think you're going a long ways with $500,000. And like Art said, you're building something that you love, that you're passionate about, because I've also been on the other side of building something that I didn't love, and I quit because it's too hard if you don't love it.
I want to just go a bit deeper into that. So yes, you should fall in love with the product and build something that has meaning, at least to you, so that you're able to go the extra mile. However, there's also some people who, with the school of thought that, look, this is a solution, and I think there's a solution that can provide not only give me funding, but I can actually be able to build it. But I don't really have that attachment to it. And I think a lot of entrepreneurs, even outside of the tech ecosystem, sometimes look for the money. And I think in the African context, a lot of people think that way. What are some of the things that could go right or wrong if you do decide to go that direction?
I think the Murphy law says in physics, anything that can go wrong will go wrong. And when you're a founder and even an investor to some extent in Africa, that's exactly what happened, right? So I would say for anyone that has a great business, not so much into it, but think that is good, we will not back it. Because even at our stage, we're feeling when things go south, we need someone that truly loves the business. And things go south, it's many things. It's the regulator coming. It's the co-founder issue. It's own family, mental health issues. It's business not going the right way. It's investors chasing us. So all of these things will happen. And so we want someone that truly believes in what they're building. And so the idea of like, I'm smart and I'm doing something, but I'm not so excited about it, it's not so relevant, especially for us at the pre-seed stage, where a lot of it is around the founder pedigree, the team pedigree, and that their ability to know and do something that no one else knows. I think later stage, and I'll let the other two speak, is very different because they have more data point to really analyze, right?
Mm-hmm.
Yeah, I mean, when you're starting out on trying to work on something you really, truly don't believe in, it just makes it so much harder because you're trying to change reality in some way. Like you're trying most of the time, if you're building a venture scale business, you're trying to build something that is truly revolutionary or changing how the world works. And I think it's difficult to do that if you truly don't believe in the business or in the business, in the product that you're trying to build. So from day one, I would always want to back someone who really believes in what they're trying to build.
You can also separate out though, like business versus startup. Yeah. There's not a problem doing this. I mean, I'm very pragmatic. So build a business. You don't have to love and, breathe every moment of it. And that's great for your side hustle or something like that. But if you're going to have to dedicate every waking hour of your being for 10 years to do it, then you really better care about it.
And especially if you're asking people to invest in your business, right? Mm-hmm. So it's just one layer, being passionate about it. There's so many other layers, right? The business has to be viable and so many other things. But the day you want to have someone else involved in your business or your startup rather, they want to make sure, okay, I'm going to give you $100K, I'm going to give you $500,000, $2 million. Yeah. Well, you better be passionate about what you do.
Yeah, and I also wanted to touch on something Nick said. I mean, yeah, there's a difference between a venture scale business and venture capitalists call them lifestyle businesses, but I don't like that name. It's kind of used in a derogatory way. But specifically for venture business, if you don't believe, then it just doesn't work out because the venture capitalists need you to completely dedicate the next 10, maybe 20 years of your life to this. Every waking moment you're thinking about it, as he said, trying to build it, trying to have extraordinary growth. Yeah. And the number of problems and things that break in that process are just so many that you will quit if you don't truly believe.
No, I 100% agree. If you're going to build, and I like that distinction that you gave, if you're building a VC-backed business, then you better love it because you're going to be spending a lot of time dedicating it to that for you to be successful. I want to get into the power dynamics when it comes to early stage funding specifically. What would you say should matter most for a first-time founder? Is it to maximize valuation or protecting control over the business, and why?
I want to flip that a little bit because I think something I've realized over the years is I don't think maximizing valuation is smart. I think it's tempting if somebody offers you a high valuation to take it, but look at like what happened in 21 and 22. Valuations got high. Great. There was a lot of money moving around. But then look 2 years later when they're trying to raise their next round, it's hard to live up into that valuation for the next round. And then they're getting stuck. Yeah. And so, again, coming back to the point of it's a lot cheaper and easier to build, I'm encouraging people to look at taking less money, keeping your valuation reasonable. So I think that's where we'll find the exits. I think there's going to be, think about a $5 million, $10 million exit. That might not be VC scale, that doesn't mean it's not life-changing money for a founder or an angel investor, et cetera. And so I think sometimes this idea of more raise more higher valuation is actually a disservice to the founders. And I'd like people to think about it a little bit the other way.
I would even take a further step back. Why do you need to raise venture money or money in general? When I talk to my friends who are thinking of starting a business, I don't necessarily try to push them into the venture route because I think many people have started raising money because it's available and because they want to maintain a certain lifestyle while they're building that business. I think you could build a business without all the pressure of VC to grow that quickly and build a sound business in some of these sectors or business models that may not truly be venture scale. I think many founders actually realize that their businesses are not going to be $1 billion business in the next 10 years, but they try contort themselves into the venture model for the money and the lifestyle. So question one is, why do you actually have to raise venture?
Do you think we have too many people raising venture?
I think there are many business models that don't need venture money that are trying to raise venture money.
That's a very political correct.
No. Because I still also think there's not enough money in venture on content. That's the problem. Those are the two things I'm trying to balance there.
Would you say that the term sheets get fairer as a startup starts to progress from pre-seed to Series A, or do the dynamics just evolve in different ways?
So the thing with that question is, when you say fair, it means that you think it's unfair in the beginning.
I'm going to check with my team about that question.
Is it unfair at the beginning or not? I think we would want to start there. What I would say is at Series A and growth stage, I think there are a lot more like qualitative stuff you can look at, and you can actually have a conversation about multiples. Like if a company is coming to you at pre-seed with no revenue, there's no multiple conversation. It's literally a lot more art than science valuing that business. At Series A, there's a bit more science, but to be honest, even though you're a SaaS business in Africa and we're trying to value you on public comps in the US, it's not apples to apples, right? Yeah. So we also try and use some sort of discretion on those multiples as well. So on the valuation side, I think it's a bit more objective than it is at earlier stage. On power, still debate. I think it's still debatable whether it's fair or not.
I think, as you said, or as Maina said, later stage is a bit more science because you have numbers, you have data. At an early stage, pre-seed to seed, obviously, at Baobab Network, we've backed companies that already have revenue, they have an MVP, they have traction. But I think it's worth saying there's not enough data point yet to say, if this is going to succeed or not. And that is why we rely a lot on what the founders do. So to your question, we don't typically handle much term sheet at our stage, actually. It's very much easy instrument, like safe, in a way it's easier for investor to wire that money, and then the valuation can be agreed later in the future, right? Or later. So for us, we don't really handle too much term sheet, but of course, once we back startup and they raise more money, they get to the level of Maina, and there, yes, there's more conversation to happen. But at the end of the day, I think it's come from both sides. Again, it's not about alignment, right? If you have someone that is too aggressive, probably not worth taking the money. I know it's easy to say, but sometimes it's easier to say no now than later, because later it's too late, right? And then it leads to many, many issues that a news outlet sometimes take on. I won't mention the news outlet, yeah.
I'll just add that I think there's sharks at all stages. They just look different. So at that early stage, it might be the uncle or the businessman in town who's like, you're really not worth anything. I'll take that 40% and here's your 10K.
Yeah.
Right?
Yes.
But then at the later stage, the sharky behavior sometimes looks very differently. Like that could be exit preferences, that could be control, that could be board seats. And, people can get gritty in very different ways. So I think you just have to know what to look for at the different stages and really find the right people who are going to be in it with you for the long haul versus trying to get theirs now. Because, if they take that 40%, they're not going to make anything out of that because they're never going to allow you to grow. You'll never be able to raise the next round anyway.
Yeah.
So sometimes these things are self-defeating, but there's still people pulling these kind of tricks.
I wanted to add into that and tying it back to your previous question. I mean, if you focus too much on valuation again, if I love the business enough, I would be like, okay, fine, I'll give you your valuation, but then I'll go into what Nick is talking about. My liquidation preferences will be a lot higher. I'll try structure warrants into that. So also optimizing too much on valuation, the investor can then go and optimize on structuring the investment in a very different way, where essentially they've paid the price they wanted, but you have that headline price. And we've seen that a lot at Series A, especially in the 2022 days. A lot of that. You have to remember the information is asymmetry on investment language is very high between the investor and the founder, in the same way that the information in asymmetry about the business itself is very high. The founder knows a lot more about the business than the investor does, but the investor knows a lot more about investing than the founder does. So you have to be careful. So don't over optimize to a price.
It's so critical for founders to work with lawyers when you get to that stage. I know it's of course, but it's important. And what I'll add, funny enough, is don't work with a divorce lawyer for this. Yeah, work with a VC lawyer, a venture capitalist.
Is that something you've seen?
Yeah, well, sometimes you have that friend or that auntie. They're lawyers. They can no. These are very, very sophisticated documents. Very sophisticated, right? So you want to make sure that you work with lawyers that I actually think it's worth paying a good lawyer to make sure you don't have this feeling, oh, you got screwed earlier, right? So I know I'm making it like a joke, but it's actually real. A lot of the founders, when they get to that stage, especially that C to Series A, right? I think Series A, they know already, but C to Series A, there's a lot of education founders needs to get, right? And it's important to have the right partners. And, I keep talking about stakeholder. One of them is a good lawyer team, a good venture capitalist lawyer team.
At the same breath, Maina, I wanted to maybe give us your take on why you think that a lot of startups are not making it past the Series A. That are yes, there's a lot of startups that are not making it past the pre-seed and there's a seed, but lots of news, obviously exaggeration from the media, but lots of news that very rarely do we see good news about someone who's got to raise a huge amount of money and succeed to make it to the other side of and there's very few unicorns that we're identifying still in the African market. What's your take on that?
People get shocked at how much financial data becomes important once you get to the growth stage. It's no longer just operational metrics that are important, but also growth metrics are very important to get past the Series A. If at Series A you are growing 2x and all of a sudden you're only growing 20% a year, you're in trouble. Because then you either have to accept a much lower valuation and people have to adjust the expectations of you, or you're not going to raise it. If you're not profitable yet, you're in trouble. I don't have a clear answer to you as to why we've not gotten to Series B, C, E. Other than to say it's also a global problem. If you look at Carter data, the graduation rate from Series A to Series B, very low. The same way that it is here. It's just our base is looks smaller. So we have a lot less companies that have actually reached Series A. So the graduation Series B, it looks even more stark because of just how few companies there are.
I think there's a need to right-size the funding rounds for the region and how fast companies can or can't grow in the region. I think maybe things started trying to copy off the Silicon Valley model, and this is what we expect in terms of growth, et cetera. And if you do that, you're kind of setting yourself up for failure. So I'm hopeful that as we have more data on this, people will start pricing things right from the beginning and also just have the right time horizons, be it fund structure, et cetera, that works for here and works that it might take 10 years or 12 years instead of 7 or 5. And then I think hopefully we'll see those graduation rates go up. I don't know. You guys are...
But I'm curious what you think about that, because I've thought of this too.
Yeah.
We should sometimes be pricing things lower because of the difficulty of actually scaling businesses across our continent. But having a conversation with a founder, let's say it's a neobank in Nigeria, and they're going for the whole continent. That's what they're selling. And I'm like, it might be difficult to actually go beyond Nigeria. If I want to price for Nigeria only, it's a very different valuation from someone going for the whole continent. And I find that a very difficult starting point, because then they'll just go to whoever believes that they can go across the whole continent, sure. And
But
the
those
rest are
people lose
very,
money.
very different.
And then they'll, get their fingers
But
burnt.
it'll take
and
10
then-
years.
I agree.
To take 10 years to find out you're wrong.
Right?
That's the thing with venture. It takes 10 years to know if you're good at your job or not.
And by that time, most people are out of that job anyway.
Exactly.
I want to take us back to the conversation of vision versus valuation. Might be mostly relevant for early stage, but I also think Series A. When founders are telling their vision, and I want to get into storytelling, there's a nudge or almost advice out in the streets that, they should probably exaggerate some of their numbers or inflate or say the truth, but just the truth in a bit with some spice into it. So would you say that that is necessary for storytelling so that they're able to, the investor can feed into the story? Or would you say that it's a dangerous form of self-sabotage? Or should there be a good balance of exaggeration? Is exaggeration okay in my storytelling?
I think a balance. I mean, that's the easy answer. But yeah, you do have to sell a big vision. But also you kind of need to believe it to get there. If you don't think you can achieve that, you probably won't. So in some ways, you have to be a little bit delusional to be a really great founder, because you have to conquer 10 really hard problems every day, every week. But then I think also investors appreciate a bit of realism, of understanding how hard it's going to be, so that, because if you don't do that, you're not managing expectations for the people coming in with you. And if they think it's going to be easy and then it turns out not to be, now you're already at odds with your investors or those people who backed you early on. So I think it's a blend.
You should never lie. That's number one. And it's about how you embellish a story. But that doesn't mean lying, right? And it touched on things around positioning, messaging, branding, and this is a skill, right? When we talk about setting a vision, that's what we listen to visionary folks, right? Because they know how to tell that story, they know how to create it. So what we tell founders, because it's part of our program, once they join the accelerator, we actually tell them how to tell the story. I mean, if you're a healthcare founder, right, you have a health tech, and at some point you realize your health tech is about providing loans maybe to hospital, and I'm just saying an example. Then you can say, oh, I'm a healthcare, and then we have this particular product where we provide loans to hospital. Or you can say you're a fintech, starting with the healthcare space. And so, if we assume, which is the case these days, that fintech is a bit more exciting to an investor, suddenly you have the same business opportunity, but you position it very differently, right? So I don't think we need to exaggerate. I think it's about how you tell the story in a way that your audience understands it. And just to finish on that point, the audience matters as much as what you say. Talking to me is very different than talking to Maina or talking to Nick. It's 3 different audiences. We are not looking for the same thing. And it's the founder job to understand that and to appreciate that, and then to change their communication towards each of us.
What are some of the things you people appreciate in looking for a story when a founder is selling to you their product? Maybe what are some advice that you could give to our listeners?
The first one is just be yourself. If you're trying to fit a certain persona, I think it'll be hard to do that for 10 years. It'll be very difficult to do that for an extended period of time. I think venture is particularly biased towards extroverts, fortunately or unfortunately, but doesn't mean that introverts can't also build truly huge and I'm trying to avoid the word visionary, truly
successful.
Yeah, successful businesses, big businesses. Every investor should be trying to see through the bullshit. So even though you're coming to me and exaggerating a lot, I mean, if I am a diligent investor, I want to find out, is there any substance to what you're saying? And it happens many times. I mean, if someone comes, sells you something, then you go and look into the actual term that they're working with, and you're like, this is actually not that big of it can't actually be a very big business. So for me, it's reduce the amount of time I'm spending figuring out what's real and what's not. Get me directly to what's real as quickly as possible, and that's the quickest way for us to work together. Or tell you that this is not for me. These are the areas I am struggling with. If that changes, we would love to look again. And getting to a quick no is a lot better than just flirting with a lot of investors for a very long time. So help us not have to wade through a lot of fakeness. Yeah. I don't know if I'm allowed to curse. Sorry.
Yes, you were. Yes, you were. You were debating if you wanted to say it again.
Yes. I realized after.
Okay. What about you?
I think I know I have a preference, and maybe this is having started a number of businesses for those founders that can tell me a lot about 5 or 10 customers versus sell me a massive vision and tell me that the TAM is this big. I think we can get there together. If you're really solving a problem, we can extrapolate to see, oh, those 10 people have a very similar problem to this other 100 people, this other 10,000 people. So in those early days, and that's where we invest, is know those 10 customers really well. Because if you haven't talked to them, probably your assumptions are all wrong. And if you're solving it for them, you can probably solve it for more. So I would certainly encourage founders to do that level of work and diligence and get close to those customers in the early days versus crafting this big vision. We've all heard a lot of flashy big visions, but if you don't know the first 5-10 customers, you're probably not going to do it.
And actually, if you're going to someone like Nick who's investing his own money, please don't bullshit it. Like you'll get a quicker check from him than any institutional VC possible. So if you can get him to the true answer as quick as possible, that's just all the better for you.
I have a question here. So you can only back one of these people. I want to know why. A brilliant founder who's unpredictable but hard to manage, or a steady but reliable founder with a safe but average idea. Who are you backing?
By far the first one for me.
Brilliant founder who's
Brilliant
unpredictable and hard to manage.
Yeah, it's not ideal, right? But what we care at our stage is the brilliant founder, right? Now we can define brilliant what it is, right? But here I'm assuming maybe he's an exited founder, maybe he or she has built several businesses. They've built a great team, because I never forget that when I listen to founders, I'm listening to one or two person. And what I'm trying to assess is how strong is their team. What I'm trying to assess is, while they're speaking to me, is the business running? So if you tell me that founder is a bit unpredictable, is a bit quirky, he's going to be a bit strange, that's fine. We've seen all of that, right? As long as they have a solid team and they are fundamentally building a great business. That's my take.
I would say, unfortunately, that the way the question is phrased is not enough for me to answer. So the reason I would say that is, the other thing I would want to know is who's bringing results. I could back a more what people would call average founder, but maybe they just don't fit this mold that people want for what is called a brilliant founder. But they are killing it. Like, they are the best in their sector. They're growing quickly. You can see how this becomes a very big business. I would want to back them. In the other case, if they're brilliant, hard to manage, but not bringing results, I don't want that combination. That's a terrible combination.
They're probably... Okay, yeah.
That's a terrible combination. So in the end, it will all come down to results for us.
Terrible to manage, but they're bringing results.
Yeah, I'm gonna have to do that. I'm gonna have to do it. I mean, for us, it's the results.
I think terrible to manage is also like another thing, like, because there's also the dynamic of the relationship between VCs and the founders that they back, which I wanted to talk about. But Nick, you can give us your take first.
Yeah, I guess just to be contrarian, I'll take the other side of that, in part because when I heard your description of the brilliant founder, I also heard like sort of unpredictable, or maybe the way I interpret it is somebody who's not going to stick around long enough to grind this thing out. Because maybe you can be that crazy visionary founder in Silicon Valley and find your exit in 1 or 2 years. But here, I don't think that's happening. And I think you got to be in the game for 5 or 10 years. And the way I heard that, I was like, this person's not going to stick around long enough
not in this
to grind
market.
that. So therefore, I'd take that other founder who is maybe doesn't have that as high of a ceiling, but are willing to grind.
I see that. I see that rationale. Actually, speaking on to the founder VC relationship, Of course, you run into so many interesting personalities. Some people who maybe introverted, don't speak the best, but still the best in their game. Extroverted, but doesn't really have enough substance. But at the end of the day, it's about results. But I, as the founder who maybe has got an investment, whether it's pre-seed or seed, these expectations you have of me and how maybe I want to run my show. And so most of the times we hear it, I personally hear it from the perspective of the founder, this is expectation, maybe we need to change this or that. I want to hear it from the lens of someone who is the VC. Where does the pressure come from that you also instill that pressure to the founder? Where do you strike your internal balance of trusting the process, encouraging them, or just you're not in sync and so this is not going to happen? Where does your bias stop? Yes, they're showing results, but maybe not yet showing results because they're telling you that you need to wait because this isn't happening. But you already have a bias that this guy might not be the guy that we thought was that or girl that we're backing. So I want to know from your perspective and your experiences.
Yeah, maybe I can start. One, we're also working on behalf of other investors. So trying to make our portfolio work out. So we're trying to find the quickest route to that as well. The same way the founder wants to build a business as fast and as big as possible. Now, the second thing I would say is we also see there's a lot of pattern matching that happens, right? And sometimes founders take it to, and I understand why they take it personally. And the reason they take it personally is their startup is their baby. When a VC who maybe has never run a business before is trying to tell them something about how to build their business, they don't take it well. But it could be we've invested in 20 plus companies. We've seen a few patterns. If you are running a credit business and you're trying to only invest with equity, it's not going to work out well. You need to start transitioning that to debt over time. Or your team is highly haphazard. Even when you are getting to growth stage, you're doing over $1 million in revenue, but you don't really have like systems for how certain things work. That also might be a problem. Now, if I think the job of the VC is to really describe to the founder why this is important, and hopefully the founder will be understanding. At the end of the day, the investor can't really force the founder to do something, but we see it many times. We can try to do something at a very early stage and the advice is not taken, and a year later you come back to the same thing. So hopefully, I don't think it comes from a place of just do it the way I want to do it because it's what we think, it's just what I want. We're trying to also get you to the highest probability of success as quickly as possible.
I think it depends on VC strategies and depends on so many things, right? But at least for us, we want to work with founders. We want them to, because when we back them, right, we understand the strategy. We've done the homework as well. We believe in the market size they can actually achieve. It's never really the slide, but and we believe in the team, right? So what matters at the stage we go in is for them to tell us, we've tried this, and now we're assessing and seeing if it works, right? And the reason we're okay with this because that's why we provided the money. We provided the money to actually help them de-risk something, right? And so we see it when founders give us reporting, monthly reporting, quarterly reporting. We see what's going on, we see what's happening. And sometimes you do pretty much everything you can and it doesn't work, and that's okay, right? That's very okay. And when it's like that, we have no issue. The problem comes when there's no result, founders don't give updates, you don't hear from them, and maybe it's when they don't have any money, the runway is short, that they come to you. That's very frustrating. Very frustrating, right? Because we are human. Some of us have been founders before. Some of us have empathy. We totally understand things can go south. But what we do not like is not to be informed, right? So I would say it's not about VC or pre-seed stage VC or seed VC stage deciding where you should go, because we don't know. We don't know. And we believe those founders, they truly are the pilot, and we are here co-pilot providing tools for them to grow. But we can only help them if they give back some data, sort of, which is equal to reporting. So I'm not really answering your question, but I'm sort of giving a bit more color as to what we should expect from founders.
Yeah. Okay. I also think you I would rather hear bad news quickly than good news quickly. So, because then you
You've
have
made
time.
clear from even the beginning. You're just like, we want to get straight to the point.
Yeah. Tell bad stuff now first, and then we can enjoy the good news over beer.
Yeah. Okay. Money is often the number one pain point for startups, but sometimes it's not the lack of it that's the issue, but it's about how it's managed. So from your perspectives, what are some of the bad money habits that you see founders fall into once the capital hits their account? The well-known ones, but also some hidden, what should I call them? Some overlooked ways that founders mismanage the funds.
I mean, I think from the basics, and this is also why I like founders who kind of grind before they even raise any money, because they really appreciate every single shilling or every single dollar and know where absolutely every bit of it is going.
Yeah.
And I think as soon as you lose that, I mean, you can't keep as tight a control when you now have a couple $100,000 or $500,000 to spend. But I think good founders still have a really good grasp on where their money is going. I think one of the things you start to see, especially when people are being pressured or feel pressure to grow, is they're subscribing to this. They're buying a lot of tools that they think will make them faster, better, scale more customers, but really they're just burning a lot of money and not getting a lot of value out of those things. So I think that's one of the big red flags of, you're spending cash that's not providing any return on that investment.
Mm-hmm.
No. One we've seen a couple of times is overhiring to mask things you should have fixed with your tech. So sometimes you'll find you raise money, you have some issues with the technology. It's you need more people to be able to manage those issues instead of just taking a step back and saying, look, thank you for the cash. We figured out there's a bit of issues here. We'd rather take a pause, fix this, and then continue on the scale journey.
Yeah.
And that can work. The trick is, again, the founder may not share that with you until it's too late. And then you're like, oh, what's happening? We're growing expenses a lot faster than we're growing revenue. So I would say that's a big one. It's to be honest with yourself. Is this unnecessary hire, or are we masking problems?
Yeah, I think on top of that, I'll say new brand office. They should need it, honestly. It's tied to more people, but typically you don't need more people, especially if you really use technology as a way to scale your business. So you don't need a flashy office in one of the most expensive co-working space in any city you are. I think that's something we've seen, sadly, quite a lot. But I'll go back to what Nick said. I think it's about understanding your cost space, right? Because we can all play with the projection. So beautiful, we all like to dream. So it's okay. But cost is real, it's what left the bank account. So we like to see funders that actually highlight that cost base. It's not just to say every month we've burned $8,000. It's where the money went. And month to month, we can really assess and see, does it make sense? That's what we like to see more than anything else. But of course, the good funders, they don't burn money into overhiring. They don't burn money into so many tools. They don't burn money into a new flashy office, right? What they do at best maybe is to give themselves more money to pay the bill and to live. And for that, we are 100% behind, right? And when I say more money, I'm not saying they're going for $200K yearly salary overnight, but you need to pay people. You need to build a team. I love hearing founders in Kenya, in Tanzania, in Morocco. They tell us, we took a bit of cash and we took we brought the team outside for 2 days offsite. Thank you. We love that because I think teams need that. And I like a founder that thinks like that. And it's okay to burn money for that because you win in the long run, right? So it's a bit of a nuance thing, I'll say, but it's understanding your cost. That's really what matters, And don't buy a Ferrari, of course.
Don't get me started.
Okay, we'll see.
You've gone through enough. Okay, on to my last question to wrap this episode out. If you could give one piece of advice to someone who's just looking to raise funding right now in this market, what's the advice you would give them?
Things have changed. I think while venture was becoming a mainstream thing in Africa, 2021 and 22 happened.
Yeah.
And I don't think the whole market has adjusted to that yet. The days where you can do a round in 2 weeks are gone. and the valuations that you will get have also changed. Because also for big public companies, valuations have also changed. So again, we'll go back to what we said almost at the beginning. You figure out who's best positioned to help you build out what your vision is, and focus on getting them in rather than focusing on the valuation. Yeah, that's what I would say.
My advice would be, as a founder, really take time to think through what you want to build. Because if you're starting off on the wrong foot with the wrong investors, etc., you're kind of doomed. So realizing, and it goes back to this earlier discussion of like, what do you want to build? What kind of business? Does it need to be venture backed? All of these kind of things. Because I think if you have that good idea, and also just being self-reflective about what you're good at, if you realize that you're not going to be great at managing an 80-person team, yet you're raising money like you're going to build an 80-person team and, be into 20 different countries, are you setting yourself up for success or failure? Because if you're honest with yourself, I think you can choose the right path early on that leads toward what you'll be good at, what you'll enjoy. I just think, unfortunately, people don't always take that time to reflect on what is it truly that you want to build.
I think it varies, right? Are you looking to raise $200K, or are you looking to raise $500,000 or $2 million? And of course, based on that, strategies are different. But what I would say to founders out there is VCs are human. At the end of the day, it's a human, right? And what humans like to see is they want to be part of a great story. And when I say story, I don't mean just the BS. I mean like a great story. You've built stuff, they can see momentum. And more importantly, they can see you've built something, you've learned out of it. And that's why, you think this way is the way forward. I do not like founders. And when I say I do not like, perhaps to rephrase it, I think my preference is not when founders just start the business and right away they want to raise money. And you don't have anything to say. You don't have any story. You don't have any feedback. No, build a business. Sadly, you may have to struggle a bit and then now go raise that money. That dynamic change. And I think VC, we see it right away. We ask the right question. We see founders actually learn something out of that journey. And of course, it makes it easier. In terms of raising more money, this is, you're competing against so many other people. Typically, it's not just in your country, probably in the region and even on the continent. And so, there's this. It's a longer discussion for the podcast. But I would say, understand your audience, make sure you've built a story, make sure you have traction, and make sure you have something to say. Maybe the one last thing I'll say is nobody wants to invest when someone looks miserable. Okay? So you need to come with a certain level of confidence. And, we say it in the street, it's always better to raise when you don't need money. And what it means is, okay, if you don't take my deal, then it's okay, you lost. Versus like, please, right? It's a lot of psychology behind it sometimes. So, I think founders need to do the work because we do it. We have to do it precisely because we're using someone else's money. Mm-hmm. But the founders nowadays, it's a great chance for them to do it. And I think it's great. It's fair. I love the founders that tease me and say, oh, I heard you're a Manchester United fan. That hurts me. But at least he knows me. And that's great. Yeah. So I'll stop there.
That's really great. I think you've all shared such valuable insights. Maybe you can let us know from the different organizations you're here representing. How can a founder get in contact with you? When are your fundraising rounds opening? Where can they get that information?
So for NaiBAN, I think it's really important to make a personal connection. The way the network works is like somebody has to bring the deal in and kind of champion it within the broader group. There's 180 of us now, and a lot of them are linked on LinkedIn that they say they're part of NaiBAN. So find somebody who you feel like could be a good fit, reach out to them. I think there is so much about relationship when it comes to investing, especially in early stage, versus just throwing in. I mean, yes, you can apply on our website, but it's probably not going to be successful because we get a very high volume of deals through the website. So better to take a little bit more time, find somebody that you can have a conversation, ask them for advice. That's always better to ask for advice than ask for money. You might get the latter if you start the conversation that way. So yeah, find us on LinkedIn, find our members on LinkedIn. I think that's the best way to get started with our network.
Okay.
Yeah. So again, for Norrsken22, I think relationships always beat. And specifically because we do Series A rounds, most of the time you might have raised a round before. And the investors that invested in that round would know us, and a warm introduction is always better than a cold one. So that's one way of reaching out to us. Second, LinkedIn, and please just also send a deck as well as the.
Let's cut you. With Maina, we cut the fluff. We just go straight.
Please just send the deck as well, because then we'll have to go. We'll have to do that back and forth, and then
You don't want to have grab the coffee and then have the chat.
I wish I could invent more time. Then I would do that.
Okay.
I wish I could invent more time. That's the other way. And then, look, even though it seems far-fetched that we'll see this, the info at Norrsken22.com, we still all go through everything that goes through there. We will respond to you. It might not be as fast, but we will eventually respond to you. So there's other 3 ways I would say you'd reach out to us.
Awesome. Baba?
Yeah, I think for Baobab Network, pretty much everything goes through our funnel. We've built technology to be able to absorb a huge amount of applications. So we typically like to have founders applying on the website, thebaobabnetwork.com. And then, they can just apply. And then from there, we can assess. Obviously, we're happy to have introduction coming from our networks. It's always good. But at the end of the day, we also ask these founders to actually apply. I think in a way, it's to remove bias, is to have data and to really understand what is that business about. I think intros makes a much more sense later stage, but at our stage, we really like founders. We see all the question, we can compare stuff. And so that's quite valuable. So I encourage all the founders to apply directly. In terms of where to find us, it's Baobab Network across the various media, on LinkedIn, I think on Facebook, on Instagram, and I believe we're even on TikTok now. So
Nice.
cool. I think we are cool, right? We're trying to be cool.
Yeah, go to them. They're better than us.
Yeah, they're trying to be cool.
We lose.
But that's where we are. Yeah, of course.
Yeah. Are applications on a rolling basis, or do you have set time frames that you're receiving?
We invest constantly, so no timeline.
Yes, Sam, we invest constantly. We do it by cohort. So as founder applies, there's due diligence process. It can take long, short, but we invest every year. We're investing this year. So make sure to apply, of course.
Okay. I'm sure everybody can find your full name, Maina Murage, Art Chupeau, and Nick Vilelle on LinkedIn, right? Okay. If you've made it this far into the episode, thank you so much for tuning in. I think this has been a valuable discussion. And if you gained a thing or two, make sure you leave a comment, or you can check us out on My Tech Story Africa everywhere. mtsafrica.co is our website, and you can check out our other shows. You can find all that if you check us out on Instagram at My Tech Story Africa. My name is Alice Kanjejo. I have been your host for this episode, and I shall see you in the next one. Bye.